Now, according to analysts, buying interest is expected to continue in Nigeria's bond space as market players take advantage of the relatively high yields to build positions, and that's according to traders. Joining me now from Lagos, where investors are seeing value at Nigeria's fixed income and forex market, is Bosun Obembe, a Forex and Derivatives Trader at Access Bank. Bosun, a pleasure to have you join us on Parliament West Africa. So it's been 5 trading days already, or 4 days, awaiting the start of the 5th trading day already at the Nigeria's fixed income and forex markets. Give us an insight into what you consider so far to have been the high point of market activities this week.
Thank you for having me, Christy. So this week in the fixed income segment, what we saw was a quiet market in the homo space. The interest has been quite low because of the unattractive levels and the wide bid-over spread, where we are seeing like a 400 basis point difference between the offer and the bid. So, but on Tuesday, we saw this bearish sentiment in the bond segment, where we saw a lot of sell-off. But we saw a retracement on Wednesday and yesterday. So on the bond side, we saw people yield went up back to, so people started buying the bonds. So unlike yesterday, we saw like a 21 basis point increase in the benchmark of the yield. So we saw the buying shares in the 2049 and 2050 and in 2026. So, but for the treasury bill space, it's been quite quiet, both OMO and the NTB, but we expect maybe a change next week.
Now, Bosun, clearly now, from what you mentioned, buying interest in the 2026, 2049, as well as the 2050 securities, signaling clear interest for long-dated tenors. Is this the new market direction going forward?
Currently, this is the trend currently, because if you look at those the long end of the curve, that's where we have been seeing the interest, and the yield is quite attractive here compared to the short end of the curve, where you see a 5-year trading at 2-3% levels, and we don't expect that the current low yield environment is going to be something sustainable. We don't expect that it's something that will last for long. We expect that there will be a change maybe later, looking at before the end of the year or maybe early next year. And next week, given we have a savings bond that is maturing, we have about 572 million maturing, so and we have the OMO maturity as well. So that tells us that there will be some decrease in yield, there will be some liquidity in the system. So we expect that the interest on the long term will continue as well.
And Bosun, speaking of market expectations going forward, latest information from the Debt Management Office says that FGN savings bond that was postponed as a result of the COVID-19 will go back on offer as from August 10. Bosun, do current market sentiments and realities support this new development?
Yes. So the auction was suspended. In April by the DMO because of the height of the pandemic. But we have maturity next week. Like I said, on August 15 maturity, we have 49.2 million maturing, and August 15 we have 5.2 million maturing. So we expect the government to actually roll over. So what is happening next week is more or less a rollover of the maturity. So you expect them to actually sell at least close to like 600 million on this savings bond. And given that this bond, the maturity is between 1 to 3 years, so you see that even 1 year B is currently trading at 2% level. So it's a good opportunity for government to actually borrow at a very low rate and reduce the cost of the borrowing, and also to encourage the people to actually invest. You see that next week, when the offer is open, it's going to be oversubscribed, because there are a lot of fund that people are actually looking for where to actually put in their fund. And the good thing about this savings bond is the interest is paid quarterly. So it's a form of encouraging the people from the retail segment that are unable to actually buy the HGM bond to actually participate in this savings bond. So for me, it's going to be oversubscribed, and it's a good one from the government to actually get some cheap funds from the investors and to actually reduce the cost of borrowing. Because if they issue at 3%, you will still see a lot of subscription on that level.